One of the hot topics at REITWeek 2009 has been the REIT industry's use of leverage, as well as the reequitization of balance sheets. We're joined today by Mike Kirby, Chairman of Green Street Advisors, to discuss this topic. Mike, thanks for joining us. Can you tell us a little bit about your take on REITs' use of leverage?
Sure. I think it's certainly the topic du jour. The whole world is in a delevering mode, and I guess the right question is how far? Because we know that what we have today is an over-levered REIT industry. We have a badly over-levered commercial real estate industry, and we've started the delevering process within the public space. The private sector really has yet to commence. And I think that's sort of the mindset of a lot of REITs right now. Let's get our balance sheet in order and ensure our investors that we're not going broke. And I think that's what's driving a lot of the reequitization so far. I think there'll be a big phase two, though, that will go on for several more years. It will take multiple rounds of reequitization. And I think for most REITs, the right answer is going to be landing at a leverage ratio far lower than they've been operating at, much more like where they came public back in the early 90s. A number, say, around 1/3 leverage, 1/3 debt, 2/3 equity. And so, lesson one is that the cost of severe financial distress kicks in at a pretty low leverage rate, say 40%. There's a difference between being 40 and 50, and 40 is better than 50. If you're getting ready for a credit crunch and we don't know when they're going to happen, you can't try to market time that type of thing. There's a second reason to have relatively low leverage, at least versus what we're used to having, and that is that there are opportunities that arise during credit crunches. And there are a lot of REITs out there, some of the best REITs in the country, where I would pay more for their stock if today they were 30% levered as opposed to the 50-55% leverage they have, because I'd be confident that they're going to be playing at the table when all the fun starts. And there's going to be a lot of distress out there. The opportunities are immense, and I'll pay up to know that these smarter management teams are going to have a seat at that table.
Mike, what has your research shown regarding the relationship between leverage and rates of return for REITs?
It's very conclusive. If you look at a chart showing the total returns of the various REITs and then stack it up relative to their leverage ratios, what you'll see very powerfully is that more highly levered REITs have dramatically underperformed low levered REITs. And of course it should be just the opposite. High leverage should buy you higher returns at the cost of bearing higher risks. So over any extended period of time you should have higher total returns. You've actually had lower total returns with more leverage. Now, the natural reaction to that is, well, of course, you're just measuring it at the end of a bust, and of course we're going to find that. It's actually true if you do the same study and draw the line at the peak pricing. And you can only do that on a 10-year basis because we don't have a 15-year track record, because REITs really didn't exist going back 15 years from the peak. But on a 10-year basis, you find the same thing. Certainly not as powerful. It's not as conclusive of a study, but it does show that leverage tends to correlate with lower returns. And, like I say, remember, it should correlate with higher returns powerfully.
Thank you, Mike. For more information on this and other REITweek 2009 topics, check out REIT.com.